Robert, Leon, Anis, thank you, Ahmed. Everybody's saying yes. Gets just a little bit delayed on the responses. Thanks, guys. You can see us.
Wonderful.
Wonderful, wonderful, wonderful.
Great. I have also started the YouTube live stream. So I want to welcome all of you that are joining us from YouTube as well. We've got a jam-packed session today talking about a lot of, very important things to watch for in the coming year. We've got we had a pretty big week with a number of central bank rate decisions, the last central bank rate decisions of the year. So we're going to talk about what all this means and where the opportunities are. But first, hello to my friends here in Dubai, New Jersey. You're not far from Boris. Australia, Bangkok, Iran. Great to see everyone online. And we will get started in just another minute to let the late stragglers come in, because we do have a lot of information to cover. And for those of you that are asking, this will be recorded, and we'll send you the recording as soon as we render it, or you can just go on the YouTube channel and the YouTube recording will be instantaneous. But all of this will be recorded because we're going to cover a lot. And if you want to watch it again, share it with your friend. You can definitely do that with the link that we will be providing you. All right. So, do you want to say hello, Boris?
Hi guys. Hi everybody. I'm just watching the YouTube feed and everything else, just monitoring. Really happy to have you guys. We're very excited. We put together hopefully some really interesting ideas for you 2024, which is definitely going to be interesting year, I think, as we get into the year. A lot of things are going to be going on. So a lot of really interesting, good trade opportunities, which is, I think, will be really valuable. So we're looking forward to just discussing anything. You have any questions while Kay is talking, feel free to type them in, and I'll try to answer them as she's talking. Yes, everything will be recorded. Yes, everything will be sent out to you. Don't worry. As long as you register for the webinar, you're going to be able to get the video and watch this on demand and review anything. Any questions, just simply email us at contact@bktraders.com. and we'll be happy to answer anything. Those of you who are not members of our Discord, please join our Discord. Even as a guest member, you can always chat with us and always talk to us, and hopefully you also can become members as well. So we're very excited, and let's see if there's any questions. So far, no. Everybody's is kind of just getting comfortable.
So let's go ahead and fire away. Boris, if you don't mind turning off you can stay on screen and turn off your screen. It's your choice.
Yeah, I'm gonna you mean turn off my webcam, right?
Yeah, the webcam.
Yeah, I'm gonna close my webcam so that we don't have any distractions from me. But I'll chime in and I'll mute myself, but I'll come in if you have any questions for me, Kay, as we go along. In the meantime, as I said, post any questions you like in the room, and I'll be happy to answer them.
Okay, so what I'd like to start with is to talk about 2023. 2023 was definitely a year that many people did not anticipate. I think at the beginning of the year, and certainly in March of this year, everyone thought that it was going to be a year of weak growth, a year of diminishing returns, and a year of potential crisis. Now, for those of you that remember, March we had the bank crisis, which could have evolved into a very significant U.S. financial crisis or even a global financial crisis. At the time, a couple of the major U.S. lenders had trouble with their finances, and it required a bailout by the Treasury in order to restore consumer confidence. And at the time, stocks sold off aggressively, and many people believed that there was going to be a slippery slope, that there were more cockroaches, underneath the hood, that more banks would fail as a result. But you fast forward to the end of 2023, and it's almost hard to remember what happened back then, because stocks hit an all-time high. 10-year Treasury yields rose to 16-year highs, and gold also hit all-time highs this year. So truly, 2023 has been a year to remember because we started off with a lot of concern and pessimism for the economy, for the markets. But the fact that stocks hit all-time highs, the fact that U.S. 10-year Treasury yields hit 16-year highs is a reflection of how far we or the world has become. It's a reflection of, how we've basically seen the economy go from, a great deal of volatility and uncertainty to, the Federal Reserve looking at the different parts of the economy and recognizing the strength of the labor market and the resilience of consumer demand. Like today, we have retail sales, which was very, very strong. So 2023, the markets hit all-time highs, the equity market, the bond market, the commodity markets. But what all of you are really interested in is not so much what happened this past year, but what can you anticipate for the coming year? And that's what we're really going to talk about today. Today, we're going to talk about the 2024 market themes. We're going to talk about, what to anticipate for this coming year, what the biggest themes are, where the risk and opportunities are, and also some of our top FX trades and our top commodity trades, and where we think the most value can be in this coming year. So to start off, there's a lot of themes that are going to be the focus of the markets in 2024. The most important of which is going to be slowing global growth and inflation. We had this week the last major central bank meetings for the European Central Bank, the Bank of England, the Federal Reserve, and the Swiss National Bank. And the message has been consistent and clear. And the message is basically that growth is slowing. The message is that, we see a period right now where, all of these central banks have lowered their growth and inflation forecasts because they anticipate 2024 to be a weaker year for the global economy. And we'll talk about this a bit further. Next year, we'll also see central banks shift their policy. We're going to see central banks begin to lower interest rates. And we'll talk about what this means for the markets, along with what this means for carry trades. Believe it or not, for the first time ever, over half of the world's population live in countries where there will be elections. Some elections will have more significant global impacts than others, but still, for 70 countries, we have pretty significant political developments that could affect what's happening domestically as well as what could happen internationally. And right now we're still grappling with geopolitical risks. What's really interesting about the geopolitical risks is that for Joe Biden and for President Joe Biden and also former President Trump, the two biggest geopolitical uncertainties of their term was nothing anyone could anticipate. For Trump, it was COVID. I mean, who would have ever thought that we would have a pandemic like the one that we all went through? And then for Biden, it's the war between Israel and Gaza. And, who would have thought that would have happened either? So geopolitical risks, the ones that we have right now, will continue to be headline grabbing, continue to affect the markets, continue to be watched by many market participants. But there could, I hope not, but we can't be remiss to the possibility of some unknown geopolitical risk, because we've seen in the last two terms of U.S. presidents in the last 8 years that the two biggest crises that these presidents have had to struggle with was things that were completely unanticipated. So starting with the focus on global growth. So what I want you to just to look at quickly here is this is what growth is expected at in 2023. And this is what growth is expected at in 2024. And you can see that from both perspectives, growth is expected to slow. In the US, growth is expected to slow from 2.3% to 1%. And Euro area, they're actually expected to grow a little bit. They're kind of a little bit of an anomaly. But in the UK, growth is expected to slow. In Japan, growth is expected to slow. And so it's just a matter of which country sees growth slow the fastest. But globally, I think that, with a lot of these central bankers are saying that they're seeing a lagged effect of the stimulus on their economies, that they have not fully seen the effect of the rate hikes. That means the effect on inflation, but it also means the effect on growth. And some of these countries have also warned of a period of prolonged, weaker growth, a slowdown that could potentially affect inflation. But that also means that it's a reflection of what's happening in those countries, in those economies. So a period of slower growth is expected, but also we are looking at a period of weaker inflation. So with a period of weaker inflation, it's almost hard to remember that last year, inflation in the US was at 8%. Inflation in the Eurozone was at 8.4%. And inflation has come down significantly. We're on the 3% level in the US, on the 2% level in the Eurozone, and they're projected to continue to fall further. So we have come very far thanks to, central bank policy. We've come very far, and that's resulted in inflation coming down significantly. But the work is not done. And, that's the message we've been hearing as the central banks wrap up the year. We heard from the European Central Bank, the Bank of England, both of which believe that, that inflation could still rise a little bit on a temporary basis before it starts falling again. And that, from the Bank of England, they told us that it is too early to say that they're done with interest rate hikes. From the Federal Reserve, we'll talk about that in a minute. But what all of this means is that between the possibility and the reality of slower growth, as well as weaker inflation, you're not going to see the magnificent returns that we've seen in stocks in 2003 or in previous years. This is a year where many people should be satisfied with high single-digit returns on their equity portfolios. This is a year where it's more, in finance 101, everyone talks about how if you get between about 5 to 7% annualized return on your investments, basically the average S&P return, you should be satisfied, and that's what you should expect. Now, in recent years, we've all been spoiled, and we've been enjoying these double-digit returns. But 2024 could indeed be one of those years where we'll still see positive returns, but it's going to be back to single digits. And that is why it's so important in that type of environment to look beyond your stock investments, to try to make alpha, to try to make return in other asset classes. And that's a lot of what we're going to talk about today. So we can't really talk about the trades that we're interested in before talking about what is in store, what we think is in store for the two largest economies in the world, because what's happening in these two largest economies will in many ways determine what happens in the rest of the world. So with the US, first and foremost, no more rate hikes. Anyone that follows me on Twitter, that's watched my videos, our BK members, even before the last Federal Reserve meeting, I've been pounding the table talking about how we're going to get no more interest rate hikes from the Federal Reserve. That 3 pauses essentially indicates a peak in their tightening cycle. They are done. So the question is, how much are they going to lower interest rates next year, and how quickly will they lower interest rates? So according to the latest FOMC projections, the Federal Reserve is looking at the Fed funds rate going to 4.6% by the end of 2024. So the Federal Reserve themselves is projecting 3 rate cuts in 2004. Now, of course, the market's always a bit more aggressive. The market's a bit more ambitious, and the market is looking for 100 basis points of rate cuts. That's already priced in 100 basis points of rate cuts. And they are looking at the first rate cut and there's a 70% chance according to Fed Fund futures. And if you follow me, I've taught, fundamentals, and I've taught how you can look at the CME Fed Watch tool. And the CME Fed Watch tool basically tells you what the market expectations are for the Federal Reserve. And the market expectations right now show a 70% chance of a rate cut, of the first rate cut happening in March. So that's what the market's looking for. No more rate hikes, and is looking for the possibility of a rate cut as soon as the first quarter. But the market itself is more aggressive in its expectations than the Federal Reserve. So how does this affect the US dollar? So in this chart, if you take a look at this chart, what you will see here is that the orange line is the Fed funds rate, and the green line is the dollar index. Now, this is obviously a very short period where we only had one interest rate cut cycle, beginning of one interest rate cut cycle, which is right over here. So we had rate hike, rate hike, rate hike, rate hike, rate hike, rate hike. Fed paused, and then they lowered. So what happened to the US dollar at that time? So during the period of rate hikes, the dollar rallied overall. Then when the Federal Reserve was pretty much done, the dollar started to sell off. It started to sell off, and what you see here is that it sold off, and then it flattened out. And then when they started to lower interest rates again, which you see right over here, when they actually started to lower interest rates, we first had a little pop in the dollar, but then the dollar fell as well. Now, it doesn't look like it's a big move, but this is this is 92 to 120, 128 probably. So this is a very big, move. And so even on this basis, this is a pretty significant move. But you can see the impact of the moves even stronger over here. And what you see here is that with the Fed funds rate, the blue line is the Fed funds rate, and the orange line is, sorry, I skipped a slide. This is what I want to show you. The blue line is the Fed funds rate. The orange line is the dollar index. So this goes further than the last graph. So what I want to show you is this was what we just looked at over here. Here was the last time that the Fed lowered interest rates again. And this was a much more dramatic sell-off in the US dollar. And the sell-off did begin prior to the first rate cut. So if you think about it, if March is the first time that the market is thinking that the Federal Reserve is going to cut interest rates, then we're going to be in this period right over here. So basically this period that you see in this chart here, where it falls before the first interest rate cut happens. By the time the first interest rate cut happens, usually I would say about 60% of the move has already occurred. This one is tricky. This one, and we had a little bit of more of a dollar rally due to risk aversion before it really sold off. So it took a little bit of its time before that happened. Over here, we had very small stepped down rate cuts. So we saw a little bit of a sell-off, but the sell-off really happens before. Now, in terms of how Fed cuts impact gold, I want you to take a look at this chart, which is that Fed fund peaks, which show that Fed fund peaks have also often signaled or foreshadowed big rallies in gold. So if you are trading gold, then this is very, very important to follow, because as you see here, right over here, Fed funds blue line peaked, and that pretty much marked a bottom in gold right here. Here, Fed funds peaked right here. I wouldn't say it marked a bottom, but it triggered the beginning of a very strong rally in the gold prices. And then over here as well, Fed funds peaked, also the beginning of a strong rally. So this is obviously a slightly older chart because it doesn't show the flat line that we've had in Fed funds with the three pauses that we had in September, November, and December. But we had three pauses in September, November, December. That will mark the peak in the Fed funds rate. And based upon 20 years of history, this should foreshadow a rally in gold. And this is a very, very important chart to pay attention to. Now, generally speaking, there's a 10-month average between the last Federal Reserve rate hike and the first Federal Reserve rate cut. So usually there's a 10-month period. And even though people get worried about how a rate cut usually means that the economy is slowing and the central bank needs to start lowering interest rates, it doesn't necessarily mean that stocks are not going to do well, because actually during the rate pause period, that tends to be the best performance for US equities, the green bar. It also is a really good time for bonds, which is the pink bar. And obviously not, cash makes no difference at all. So equities can perform very well when rates are on hold. And if you think about it, it makes sense, right? Because investors are starting no longer feeling the risk of raising interest rates, of higher interest rates, and they're feeling more willing to take on risk, and they see the future of lower interest rates, which is generally positive for stocks. So even though we're looking at looking into a period of possibility of weaker growth, I think that we are also not necessarily going to get a sell-off in stocks, because usually in the rate pause period, according to what we've seen in the past, stocks tend to perform well. Now for the US, the biggest thing that you're going to hear everyone talk about for the US and the US economic outlook for the coming year is election madness. We've got a very big election here, and with elections, it's something that the market always focuses on, but the stakes are so high again and the consequences, so significant for the entire world that everyone is going to be watching these elections. And election years are very interesting. I love to show you charts showing past history because they're so telling in terms of what could happen in the future. And you can see here that presidential election years actually tend to be good for stocks. So you can see with presidential election years throughout history, the S&P 500 has not declined during a presidential re-election year since 1952. So that is very, very significant, with a 13% average annual gain in re-election years. Now, of course, not every re-election year is coinciding with a change in the Fed cycle, coinciding with a period of slower growth. So that's why I think this 13% could be more like single digits. But I am not so worried about the stock market crashing this year because, first off, usually Fed pause periods are good for stocks. Usually the S&P, rallies when there's a re-election year. And so all of that gives me comfort to think that stocks could still rally this year. And the US dollar actually tends to perform well in election year as well. This chart doesn't have the most recent one, 2022, which was actually a negative performance for the US dollar. But overall, 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 11 years, election years, we had the dollar index rally. So I think that this also tells you that we could potentially get a dollar rally this year. But it's a close call. And, Biden's approval ratings, usually the incumbent has a greater chance of victory, but Biden's approval ratings are now lower than Trump, and people are saying that we could potentially see a Trump victory. So what would a Trump victory look like? It would look like, it could look like in many ways the same as his term, but there are a couple of things that will be different and more important to watch, which is that now we truly understand Trump's America First policy. And now this America First policy can have more broader ranges economically and politically. So, for example, there could be more economic protectionism. His advisors, and Trump and his advisors, have been talking about a blanket 10% import tariff. Now, that's obviously very, very high, very significant, very unlikely to be passed. But it is these measures like this that I think is going to be what comes out of the Trump administration. America First also means that, Trump, it will probably end the, U.S. involvement in the Ukraine war. Trump won't see the reasoning for shedding American blood as well as spending American monetary resources on a war that has very little impact on America. And so it is expected that he would end the U.S. involvement in the Ukraine war, which would be very significant because then that whole burden goes onto the shoulders of Europe, who will then have to up their spending in order to defend, protect Ukraine. But a Trump victory would mean a quick exit from the Ukraine war for the U.S., and that could actually mean the end of the Ukraine war. Trump will probably also see very little reason to defend a tiny island nation at the expense of such an economic giant, China. So he'll probably abandon the Taiwan deal and align himself with China because he probably sees very little American benefit on everyday benefit to get engaged in this. So the protectionism could have global policy impact, and it could have economic impact. But there's also one more scenario, right, Boris?
Yes, the scenario that I think is quite reasonable, simply because it's really a crazy year this year, is that we could have a situation where neither Trump nor Biden are the final nominees of the party. I know that sounds absurd now, given the fact that there's nobody really opposing Biden except this one congressman out of Minnesota, and they're not even letting him on the ballots in half the places. And Trump seems to have a 50% lead going forward. But both candidates have very serious odds against them. Biden is clearly old, whether you like him or not, and there's lots to like. I mean, if you sort of judge Biden strictly objectively, it's been one of the most successful presidencies we've had in a long time, economically, geopolitically, and every other way. But the fact that he just appears old is an incredibly negative aspect of it. So we'll have to see if the American electorate is going to just simply accept that fact and vote for him. And the fact that his approval rating is at 31, while the economy is literally hitting, I know it's hard to believe, but we're literally hitting best economic performance we've had in decades, although most people don't think so because the price levels are high. But trust me, when you look at the actual economic data, you're earning far more money than you did before the pandemic and actually have a lot more money, which is why every airport is crowded, every vacation spot is impossible to get to. If we were really in a bad recession, none of that would be true. But that's I think is a very, very important point. And there may be a situation politically where the Democrats are simply going to just shove him out because they see no chance of winning with him. With Trump, the risk is completely different. With Trump, the risk is actually judicial. They're going in front of the Supreme Court. If the Supreme Court kind of rules that he's not immune, in other words, now that he's a private citizen, they can't try him. He really stands a very, very serious risk of being tried during the election. So there's all sorts of unbelievably unprecedented historical aspects to this election. And what seems, completely like a giveaway right now, it seems like a given right now, could actually be completely different 3 months or even 6 months down the road. The point is that by June, July, we could have a completely different terrain politically, which will have very different impact on the economy than we think. If there's a lot of turmoil and, who knows on the Democratic side and who knows on the Republican side is going to come out as more leading candidates. I think the point being is that two unknown candidates facing 2024 election would definitely be a turbulent event for all the financial markets. And you can't discount that just yet because it could really be a possibility. So yeah.
But at the end of the day, the election is not until November. So there are many months before that, and usually the Democratic candidate isn't even announced until I think August at the earliest. And or the incumbent candidate isn't announced until August. So that means that we have a lot of economic activity, a lot of market focus that may have nothing to do with the election. So a lot of people will be talking about the election, but the actual impact of the election will be felt in 2025 versus 2024, or right after the election in November. So there's a lot more going on before that, including China. And with China, the main thing to know about China is that China is poised for a weak recovery. China can no longer rely on the post-COVID reopening rebound. The post-COVID reopening rebound was already lackluster at best. And so it's been so lackluster that China decided that they're going to start not releasing most of its economic reports. They started to, for a while, they started to, stay quiet under the economic reports and only release what was minimally needed. And, it is widely believed that they'll be struggling to meet their 5% growth target for the coming year, because we are, in an environment where, the economy is the recovery has been very slow, and the economic stimulus has been lackluster, and they no longer have the support of the initial reopening wave. So they're going to struggle. In this chart here, you see black line is actual growth, blue line is the growth target, and it's all pointing downwards. I think that if they were to meet their 5% growth target, it'd probably be through some massaging of numbers than really being able to achieve that. And in reality, not achieving that growth is a reflection of the overall slowdown in the economy. And aside from weak growth, China is also dealing with deflation, which is kind of unique, right? Because the rest of the world is dealing with inflation and too much inflation. And China, on the other hand, is dealing with deflationary pressures that are worsening. So China's troubles have global implications, particularly for those of you that, and me included, love to trade the Australian and New Zealand dollars and the Japanese yen and Asian currencies in general. China's troubles have global ramifications, and China's troubles include not being able to count on the post-COVID recovery. Another big problem that China has is that youth unemployment has hit a record high above 20%. And a lot of youngsters in China have decided to move back home and become full-time children or seek a higher master's degree. They're no longer in the workforce. And by no longer being in the workforce, they're basically reinforcing the slowdown in growth. Also, the deflationary behavior could persist, because there's a lot of articles about how the Chinese after COVID, they started to get smart with a lot of discounting deals, because what happened was a lot of Chinese businesses started to discount, but you had to reach a certain minimum in your online orders in order to get the free shipping and the discount. So the Chinese would basically order as much as possible to get the discount and then refund it all backwards, and that's hurting corporate profitability. It's so significant that's actually become a story in the markets. So that is also a reflection of the sentiment being much more nimble, and also the sentiment being the people are much more worried about growth and less freewheeling with their spending, and that will have not only domestic implications but regional and global implications. And China. Basically, if China sneezes, the rest of the world could still catch a cold, especially in the Asia-Pacific region. Now, China also, is facing or watching the elections in Taiwan. Taiwan has a big election this year. We started this talk about how there's 70 elections in the world in the coming year, and one of which is Taiwan. And it's really important and interesting because the two parties have a very different stance on China. The current party, has the current stance, which is, they want to, be independent from China and oppose them. The KMT party basically wants to go back to some sort of 1996 understanding where they're, have a arm's length relationship with China, but a relationship where they kind of operate in terms that they agree, and China supports that group. And so depending upon the outcome of the Taiwan elections, which are happening in the beginning of the year, we'll understand what China's stance on Taiwan is in terms of a military engagement for the rest of the year. So the U.S., how the prospect of growth in the U.S., the prospect of equity market gains in the U.S., along with the outlook for the Chinese economy, will impact all of the trading opportunities that we have this year. So one of the things that it will impact is carry. 2024 2023 was called the golden year for carry, where we had very, very strong moves like this one in dollar yen. Pretty much from 2023 January all the way up till November. It was a almost quasi one-way uptrend for dollar yen. We had a little bit of a drop during the bank crisis in the US, but then it snapped back. And you see this type of performance across all of the Japanese yen crosses, which is that 2023 was the golden year for carry. And that was because all of these major central banks were raising interest rates. And for those of you that are learning about fundamentals, I often will say that in order for carry trades to perform well, we need an environment of rising interest rates, we need an environment of rising stocks, and we need an environment of optimism. And we definitely had rising stocks, we definitely had rising interest rates, and we sort of had optimism. And that's the environment where carry trades perform best. And that, for the most part, was the environment that we had last year. Now, in the coming year, we are going to be looking at first a period of unchanged policy. So you're going to see a period where central banks basically keep interest rates unchanged. And then you're going to see central banks start to lower interest rates. And when they start to lower interest rates, that's bad news for carry trades, because that means that the interest rates that are being offered by these central banks are starting to shrink. So it creates a motivation for these for investors to get out of their carry trades. And what's even worse is the fact that the currency down here, the currency that's been used to fund the carry trades, which is the Japanese yen, the red line shows what yen futures are pricing in for their yield, shows and interest rates rising in Japan. So Japan's going to be the one that's going to stand aside where they're raising interest rates where everyone else is lowering them. And that is the worst environment possible for carry. So one of the things that you need to be looking forward to this coming year is that it's going to be the end of the golden year for carry, that carry trades are going to start to suffer, carry trades are going to underperform, especially, and basically when these central banks start to lower interest rates. You may still have a little bit more juice, but usually investors are proactive in pre-positioning for rate cuts. But you may have a little bit more juice in the traditional carry trades. But once they start to lower interest rates, expect the carry trade gains to go poof and disappear. So in that case, where's the opportunity? Where are the trading opportunities? Well, let's listen to this legendary investor, Warren Buffett. Warren Buffett is betting on Japan. Why Japan? The reason why Warren Buffett is betting on Japan is because Japan is finally experiencing its fastest price growth in 30 years. And inflation, all these countries around the world are worried about high inflation. Japan is celebrating it. Inflation, after so many years of deflation or stagflation, is above 2%. And that's actually supporting wage and consumer spending. It's making, as prices rise, wages are finally rising. And the rising wages is causing people to spend more. Japan also has a bright outlook because the wars in the Ukraine and the war with Gaza is sparking new investment into supply chains and manufacturing. And while Japan may not necessarily be a direct beneficiary of supply and manufacturing, they create a lot of the high-tech processes that go into building those factories, and a lot of the AI technology that goes into building the factories. So they will benefit from the new investment in supply chains. What's also really important is that there's a demographic shift. Many of you know that there's a very large aging population in Japan. And that aging population is getting so old that they're going to start moving out of the workforce. And there's been a significant focus in Japan on startups. And they're trying to invest in startups. They're trying to invest in startups by the younger generation. And so we're starting to see demographic shifts where the younger generation is getting more into the workforce and also, encouraging startups, while the older generation is beginning to exit the workforce. And that shift, of course, is going to be a shift that takes time, but that shift could have dramatic impact on the future growth for Japan. And also, Boris, do you want to talk about the low cost of capital?
Yeah. So the other 2 points I think are really important to understand. Japan as an investment story is interesting precisely because of it's way ahead of everybody else on a demographic timescale. It is the oldest of the advanced industrialized nations. So it has the greatest amount of experience at using robotics and automation to essentially fulfill the labor gap, right? So factory automation is something Japan is very good at, and that's something that we're going to need in the US, something we're going to need in Europe, where the Asian populations are very large. Healthcare that requires automation, because there really literally isn't enough people to take care of the elder population in Japan. Also something that's on the cutting edge. Those are all trends that the rest of the industrialized world is going to absorb, and Japan is going to be a net exporter of all those services and products. And of course, it's incredibly, incredibly cheap. And it is the second largest capitalist economy, democratic capitalist economy in the world that is very, very stable. Just how cheap it is, you can take a look at the next slide, where you can compare the Japanese price earnings ratio, the Nikkei price earnings ratio to US, Europe, and emerging markets, and even China. And Japan, which is in blue, is essentially trading at like 13 times earnings, right? Very, very, very cheap relative to 21 on the US side, 15 in Europe, essentially, matching emerging markets and China, none of which have the kind of transparency and the kind of stability that Japan offers as a market. This is a reason, Warren Buffett is a famous value investor, and this is the reason he's really making this bet. Great companies at really, really inexpensive prices. And he's also, of course, making a bet into the great Japanese trading houses. Mitsubishi, Mitsui, Sumitomo, all of those are massive trading corporations that hold huge investments in a wide array of commodities. And that's something that we should also be paying attention to. Because when you really think about how we as retail traders can express this bullish Japanese view, one way, very, very obvious, is certainly the Japanese yen. If the Bank of Japan goes into a tightening mode, even not necessarily hiking rates, but let's just simply, removing yield curve control and just simply actually creating positive yield on their yield, it's going to really strengthen the yen tremendously. Remember, yen is at like 145, 150. It can go to 100. That's just a massive move to the downside. If the yield differential between Japan, two things are happening. If Japan is raising rates and US is lowering rates, the yield differential dollar yen really starts to compress. That's very positive. And secondly, because as they're making this big bid into commodities with a more expensive Japanese yen, therefore they're able to afford to buy more commodities. Because it's a big trading powerhouse, you can also be very positive on the commodity front. We'll talk about specifically which commodities I think are going to be very attractive in 2024, but generally as a theme, those are two things you want to keep in mind. But honestly, the other great way to take a look at Japan is to simply recognize that the Nikkei is making a very powerful U-turn shape around. So yes, we're still under the 1988 all-time highs at around 40,000. But what's really important when you're looking at a longer-term trend here is where are the highs and the lows? And as you can see that all the way from 88 till about the global financial crisis, on a longer-term chart, we've done nothing in these red circles but create lower highs, a super bearish construct that really wasn't broken until just before the pandemic, when we took out the highs, the previous level highs, but more importantly, held the lows. And what you see continuously since the essentially 2017 is that we're holding higher and higher lows. That's incredibly bullish from a long-term perspective. It essentially suggests that we're going to challenge the highs over here, and certainly there'll be there'll be enormous amount of hand wringing as everybody's going to go, oh, it's going to be a double top, and it may back off the highs. And this chart is sort of very, I think, emblematic of where the gold chart is as well. But the point being is that if it starts pushing through, if we go through the 40,000 barrier, it could really soar much more beyond that, because once it kind of takes out those numbers, there's going to be a huge amount of interest. I was just reading that something like over the last 20 years, the U.S. market was doing about 9%. The Japanese market returned essentially 4.5%, 5%. So there's been very little international interest. Imagine if we start hitting highs here. We start hitting, 39, 40,000 as we go forward. That's going to bring all that international interest back into Japan, which is the Nikkei is the second most liquid market in the world, right? Huge market. So it can absorb a lot of foreign capital. So I think it's setting ourselves up for a very, very attractive trade here. You want to be on the side of Warren Buffett. He's always early, but he's rarely wrong. And I think long yen, long Nikkei is kind of a self-reinforcing trade. Now, another interesting trade in Asia that is definitely worth looking at is what I would call the replacement of China trade, India, which is really now becoming the jewel of Asia. India is really, really soaring on just every possible level you can imagine, mainly because, if you can go to the next slide, Kay, mainly because it's not just the fastest major growing economy in the world at around 5-6%, but projected to go to number 3 globally in GDP by 2027 and number 2 by 2074. It's already seen its stock market bypass $4 trillion and pass Hong Kong as a capitalization market. And this is all against the background. Think about this. You kind of have to think of India as the early days of China with a much younger population that is also democratic, right? That has far, far more freedom per individual than anywhere in China. And while it may be chaotic and disorganized and all those other things, it's actually creating a much more organized, much more structured model where its population is getting healthier, getting more educated, and the mass of that population is just enormous. Everybody talks about, oh, China is just such an enormous market. Just, the middle class in China is bigger than the whole population of the United States of America. That's going to be true of India too. It's going to be both a massively producing market, but also a massively consuming market. And on the investment side, you've already seen doubling the investments, investors, excuse me, from just 2019. There was 39 million in 2019. Now there's more than that, 77 million today. Next slide, Kay, if you can. So largest democracy in the world, British rule of law, which is very, very good because, again, remember the biggest problem with China is autocracy and essentially state determining what it is that you can own and not own at any given time. I mean, we all know the story of Jack Ma, at one time one of the world's wealthiest men, who basically was stripped of all of his assets by dictate. That can't really happen in India, which has a rule of law, which is very, very attractive to investors. Young demography, right? Indians are very young, very well educated, tremendously. I think we can all see it. I mean, the top CEOs of all the major tech corporations in America are all Indian. They're all Indian. I mean, it's just the Indian diaspora alone is a huge value to the economy. And the only thing it really needs is top-notch infrastructure, which will be coming. Because the moment India gets beautiful highways, really fast bullet trains, everything working on time, it's unbeatable. It's really unbeatable as both a market and a producer. So it'll be very, very interesting to see. Of course, the Nifty 50, which is really the one way you want to trade India, that's the trade. That's the trade here. It looks like it's parabolic, but that's exactly right. When things are great, they tend to go tremendously parabolic. And even though it looks like it's completely overbought, I think in many ways it's just the beginning of this incredible cycle. It's not inconceivable to think of the Nifty 50 being 50,000 3-4 years from now. You can see these very, very sharp moves to the upside, but they're all holding their lows really, really well. So there's just no easier way to trade India than to simply just buy the Nifty 50.
So let's talk about what our favorite Forex trades are, or what my favorite Forex trades are. The first one is short Euro Yen. Now, what you see here is that inflation in the Eurozone has pretty much gone back down to the 2%, to their target level. It's pretty much there. So even though today we had the ECB talk about inflation rising in the short term, and we had a pretty strong rally in the euro, she also talked about how, growth is slowing and how inflation is easing in the long term. So even though we had a very strong rally in euro after the ECB meeting, the outlook for the Eurozone is grim, because not only is inflation already, getting back to target, meaning that they're much closer to an interest rate cut, but this chart here shows you the blue line being the employment, what's actually happening in terms of job growth, and the orange line being the employment component of manufacturing PMI. And you can see that the orange line oftentimes lead the blue line, which means that the PMI report, and if you know about fundamentals, or you follow anything in terms of fundamentals, I talk about how I love the PMI reports. The PMI reports are so important. They're so good at telegraphing what's going to happen. And so the employment component of the PMIs have been crashing. And we have not seen the crash in jobs in the Eurozone yet, but you can see from this chart that goes over more than 20 years that it almost inevitably happens. And so we are very much looking at the great risk of the labor market crashing in the Eurozone, leading to further weakness in the Eurozone economy. And the Eurozone economy is already expected to be weaker. According to the European Commission, they lowered their GDP estimate, and even the ECB at their last meeting today lowered their GDP estimate for this year and next. The yellow was how much they expected it to grow before. The blue is how much they expect it to grow now. And so it's like half that. So the outlook for the Eurozone growth is weaker. We're looking at the possibility of a pending, surge in job losses. Inflation is almost pretty much to target, which means that the ECB is very, very close to lowering interest rates. And if you look back to this global carry trade slide that I pointed out, I want to show you that the blue line that I'm pointing to is the ECB. And the ECB this dark blue line here is the Federal Reserve, and this is the RBA, and the ECB is this green line right here. So this is ECB. The point I want to make is that this green line is falling first. This green line and the orange line, which is the Bank of Canada, the ECB, are among the first central banks expected to lower interest rates. And so the rate cut bets are growing. And that is why I like selling euro yen, because not only are the rate cuts bets growing, but if you listen to what we had talked about before and how Warren Buffett is betting big on Japan, and how Japan, we laid out all the reasons why Japan could really be a growth story in 2024, how the Bank of Japan is expected for the first time in decades to raise interest rates. That is going to be positive for the Japanese yen and negative for euro yen. And in particular, if the ECB starts to lower interest rates, that's also going to be bearish for euro yen. And for the first time since March, we are seeing euro yen drop below the 20 SMA. Now, whenever I trade, I always talk about combining fundamentals with technicals. And there's a lot to learn with fundamentals, and that's what I hope to teach you. But technicals is also very important. Fundamentals tell you what to trade. Technicals tell you when to trade it. And we're already seeing euro yen drop below the 20 SMA, which is signaling a possible, downturn in the euro yen. So we got fundamentals and technicals on the side. The second trade that I really like is short euro kiwi. Now, I just laid out all the reasons why I'm bearish euros, but I'm bullish kiwi because the RBNZ has recently raised its rate projections. They now expect interest rate cuts to come later. And they expect interest rate cuts to come later because they feel like the economy is doing better. We heard from the RBNZ governor at the last meeting. He said we even discussed the possibility of raising interest rates in November. So when everyone else is done and not really thinking about raising interest rates, they were forthright and said, we thought about possibly raising interest rates. And we could still raise interest rates again if inflation doesn't fall. So as everyone else is going to neutral and winding down their message of rate hikes, the RBNZ is saying, we could raise interest rates again. Why? The reason is because, why do I like Euro Kiwi? first of all, I expect weaker Eurozone growth in the coming year, more job losses in the Eurozone, ECB among the first to cut interest rates. But New Zealand, the New Zealand economy is set to gain momentum. Sentiment is improving. We're seeing a record amount of tourism in New Zealand, and there's a rebound in tourism happening as well. But most importantly, this past year, there was a record amount of migrant arrivals, and this migrant arrival is leading to house prices being stickier. It's leading to prices in general remaining high, and the RBNZ has expressed concern that this record level of migrant arrivals is going to make it more difficult to bring inflation down, which is why RBNZ Governor Orr said we could hike again if inflation does not fall. So I really like Euro Kiwi to the short side. I threw on some fibs on my chart here showing how, even though Euro Kiwi has come down a bit, we're in the weekly chart, there's still a lot more room to fall to the downside. We could easily get down to 170 in Euro Kiwi in the coming year, which 175 would obviously be a closer target, but 170 is probably achievable as well. The third Forex trade I like is the Juiciest carry trade. The Juiciest carry trade, as carry trades start to get unwound and there's less and less opportunity with central banks lowering interest rates, the Juiciest carry trade is going to be in the Mexican peso. And the reason for that is because, first of all, interest rates in Mexico are very high, 11.25%. That is, a pretty juicy carry trade there. And Mexico, I'm sorry for how this is blurry, but it says Mexico economy posts its 8th consecutive quarter of growth. So the economy is also doing very, very well. And then we have industrial production rising. And you see industrial production activity, the blue line is Mexico. The green line is the US. Manufacturing production is up quite a bit in Mexico compared to the trends in the US. And also remittances, which means that it's, Mexican citizens that are working abroad in the US and other countries, they're sending more and more money back home. And by sending more and more money back home, they are increasing the wealth and investment domestically. So remittances have been on the rise, and that's been translating into greater private investment. So private investment has surged in 2003. So the Mexican peso is a very attractive carry trade because, first of all, we have a very high interest rate with no rate cuts on the horizon at all for New Zealand next year, for Mexico next year. Whereas everyone else is talking about interest rate cuts, Mexico is not even thinking about lowering interest rates. They, in fact, have recently upgraded the 2024 growth forecasts. There's also been strong remittances. There's been a surge in domestic demand and investment. Inflation is still above target, well above target, which is why they're unable to lower interest rates. And fiscal policy is expected to support growth. So my favorite Mexican peso carry trade is actually the peso against the Swiss franc. Now, many brokers do not trade this cross. Some of them do, not many of them don't. So you'll have to construct the trade by going short dollar Mex and going long dollar Swiss. But the carry is significant. The carry is, 9%, which is very significant. So what you would do is you would go short dollar Mex and long dollar Swiss. Mex yen is very, very common and provided by all brokers, but we just talked about how there's a lot of upside to yen, and so it's not really that attractive. Maybe you could squeeze a little bit out of it because the Japanese are not expected to end their yield curve control until the latter part of the year. So Mex yen, the peso yen, could still be some opportunity in the front of the year, but I really prefer the Mexican peso against the Swiss franc. So now I'll let Boris share his top 3 commodity picks.
Yeah, hi guys. I love Mex. I got to tell you, my wife just came back from Mexico on just a little bit of a vacation trip, and she was just shocked at the amount of wealth, the amount of infrastructure that's being built over there. And I think you have to understand that we're underappreciating the fact that Mexico is going to replace China as a major manufacturing hub for the US and maybe for other countries as well. And Mexican workers are actually now more productive than Chinese workers in most of the manufacturing plants. So very, very fascinating. It's something that I think is going to sneak up on us as a massive growth trade, not just for this year, but for the next couple of years. People will be talking about it. Now, turning attention to commodities, where everybody, of course, is seeing some, lots of waves and topsy-turvy moves going forward. I think there's 3 commodity trades in 2024 that very much are worth taking a look at. Let's take a look at the next slide, and we'll go through what I think are the 3 most important commodity trends for us to watch. They are copper, oil, and gold. And we'll start with copper, which is really called Dr. Copper because it's essentially how copper goes. It's the rest of the world economy goes. Copper used to be sort of the primary wiring in electricity and telecommunications. So people would always say the moment the global economy expands, it's copper demand goes up. But actually now copper is the foundation for clean energy. It's crucial to solar, EVs, wind. The International Energy Association expects 250% increase by 2040 in terms of the use of copper. And here's the thing, copper mines are actually depleting. So you have this just perpetual secular demand against a relatively constrained supply. When you look at copper on the charts, if we could take a look at the next chart. If you look at the copper of the charts, you had this massive move post-pandemic to the 5 level, came right back down to essentially 3.5 level, been consolidating there. But that whole level at 3.5 has been just rock iron support. And to me, I think that's really the trade here. The trade in copper here is long anywhere around 3.5 with a stop below 3, because if it crashes below 3, then we clearly have some recessionary moves that could be much more negative for us for quite a long time, with a very reasonable move even to the 4.5s, possibly even up to the 5s, depending on just how tight the supplies are going forward. But it's a great risk reward trade. It's relatively smooth. It shows some very clear support at these levels, and it has some great fundamental stories behind it. So that's copper as far as one of our commodity trades. Now, oil, which is really an interesting trade. Who would have said that at the beginning of this year, who would have said that as a result of the tensions in the Middle East, oil would go down? I mean, who predicted that? Nobody. Everybody thought we were just one battleship fire shot away from blowing Iran out of the water just about a month ago, and yet oil just continues to go down. So it's interesting. Why did oil go down this year significantly? There's a lot of reasons, but I think the primary ones is obviously slowdown in China. China's been a massive absorber of energy, and they're kind of at peak of their reindustrialization, so they've kind of slowed down a lot. There's been a huge flood of supply from OPEC and Russia. Now, what's interesting, speaking of India, the other thing about India that's very interesting is India is very neutral. So they've been very strong at being able to, they've basically been buying Russian oil at $40, $50 a barrel, reselling it back out to everybody else after they take the oil for themselves at 60, 70. And that's how they've been recycling a lot of Russia. Russia had no choice but to pump out all this oil to them at these prices because they can't keep it in the ground. It would have been frozen. And of course, U.S. released a lot of SPR. And we now have close to 8-9% of the cars that literally don't use gasoline. It's a massive marginal cut in the demand of oil. So these are all things that really drove oil hard to the downside, right? However, as we go into the next year, there's a lot of reasons to think that we could have a complete change of dynamics. First of all, China is reviving and India continues to explode, right? OPEC is at capacity. Saudi Arabia can't produce very much more. Russia can't produce very much more. And there's no oil coming from the SPR. As a matter of fact, the intelligent thing right now for the U.S. SPR is to actually for the U.S. government to become a buyer. These are good prices. So instead of being a net seller, they could be a buyer. That obviously creates an underlying bid. I think the whole point is if U.S. gasoline prices are underneath $4 a gallon, the consumer is placid, and this would be actually a very good time to buy the bid. And then the other thing that's sort of really interesting, and I think people don't appreciate it, is that the EV revolution is really not. It's not like the computer revolution where every year it was going by double digits, and every year more and more computers were coming because there was a clear advantage to owning a computer, right? And there was a clear advantage to owning a laptop versus a desktop, and so on and so forth. There was this very, very upward scaled until everybody in the world owned them. There is very little, especially with lower oil prices, there's very little reason to want to own an EV right now, because there's two things that are very negative about an EV. One, it takes a long time to recharge it, if you're not plugged in the house. So you have, range anxiety. And number two, if something goes wrong, it's literally replacing the whole car, right? I mean, that's why insurance companies hate insuring EVs, because if you drive an EV over a rock, they got to replace the whole battery chassis, which is like literally replacing the whole car. Yes, there are no moving parts, but the one part you need to replace is like the whole value of the car. So EV growth has really faltered. It's gone from 77% in 2022 to just 29% growth in 23. That's not a good look. And I think all of those things suggest that, oil may be here for longer than people think. And as we look at the chart, more importantly, we can look at the next chart, you can really, really see that the equilibrium price of oil over the last, a decade and a half has been that 60-65 basis, right? We've had obviously massive dips during pandemic, but those were ridiculous spikes. Then we had a huge spike in the Russian-Ukraine war, and they came back down. And we're basically at support. We are at the median level. So if you think this is support, great value proposition. Doesn't have to go far for you to make money. Your buyer here, underneath 70. I think just basically, if you're a buyer in the 60s to 70s, going forward, you have a very, very strong chance to at least see 20-30% on the trade. So you could have an 80-90 trade. That's the key thing. Now, the last most interesting, I think, commodity trade is gold, which has really been making lots of noises lately. The first thing that I think is interesting is that, we're done with the Fed rate hike, right? Kathy just went through and talked to you about that. That's super bullish for gold, because gold hates high yield. High yield compete. Gold has no yield, so the higher the yield, the less people want to park their money in gold, which has negative carry. So once the carry starts to compress, that makes gold that much more attractive. But the real reason that gold is attractive is because people begin to worry about sovereign debt pressure. Yesterday, my wife, who's a hedge fund stock analyst, really doesn't do macro, was asking me, why did the Fed become so unbelievably dovish in this press conference? It shocked me too. And honestly, there was no good fundamental reason for Powell to be so dovish yesterday, except one. I thought about this for a long time, except one. The single biggest reason that the Fed wants to cut rates is this: the U.S. deficit. Are you aware of the fact that we're at a point now where the interest rate, just the interest rate service, the service of the interest rate, is now going to become the largest budget item in the U.S. deficit? That's incredibly unhealthy. That's incredibly wasteful. I mean, if you're paying interest as your primary budget item on a fiscal budget, it's incredibly wasteful, because you're not really using any of those resources for the taxpayers, right? You're using it for savers, but not for taxpayers. So large deficits are very threatening to sovereign debt security. If you have, if the market kind of, right now, the yields have all gone down because of the Fed rate lowering forecast. But if auctions don't go well, if auctions are not really going to be absorbed, and you see some sovereign debt pressure, that's going to be very, very positive gold, very negative paper. The last two times we've had a very unusual quarter where the gross domestic product has been positive, but the gross domestic income was negative. Last two times that happened was 2001 and 2007, and after both of those times, gold really soared. So look at the chart, and you obviously have, yes, all these multiple fake outs. If you're sort of a very, very short-term trader, all these kind of multiple fake outs at the 2100 level. Even last Sunday's Asia Open turned out to be a fake out. But here's what you need to watch, and this is what I find super interesting. Every time we're retreating, and even right now as I'm watching gold is holding 2000, right? We're trading 2030, 2020. There is a bid underneath this product, and the fact that there's bid underneath at higher levels means that is very, very positive. Remember, the actual inflation adjusted high for gold is 3,300, set in 1979, I think, right? So we're nowhere near our inflation adjusted highs yet, which means that we could see a very, very strong move. This is why I think this trade, I mean, we are starting to day trade gold much more actively in my day trading room. And I think this is going to be the day trading instrument. Forget the long-term trading instrument that everybody's going to be trading, because gold, volatility-wise, is 3-4 times more volatile than stock indices on an intraday basis. So I think this is going to attract a lot more people, and you're going to see this as a very interesting trade going 2024. So that's commodities. Now, my final kind of idea for everybody is NASDAQ, which I think is, nothing looks better than NASDAQ right now, up 50% year to year, right? But let's talk about why this could be the most dangerous trade of 2024. What is really comprising NASDAQ? NASDAQ is what's known as the Mag 7 index, right? Magnificent Seven, after the Kurosawa's great movie, that basically comprise 90% of the NASDAQ gains, right? The Magnificent Seven, we can go to the next slide. They are, we all know they are Microsoft, Tesla, Amazon, Apple, Nvidia, Meta. These are stocks that are stratospherically expensive, with the exception of Meta. They're all trading way, 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 way above their growth rates. There are really only two stocks on this list that are what you might call reasonable in terms of their pricing, which is Alphabet and Meta, right? And time will tell as we go forward. But Tesla at 122, Apple at 28 times earnings. Apple, I gotta tell you, I may be 100% wrong, but every ounce of my body says that Apple is going to be the single biggest disappointment in the NASDAQ next year. My store on the Upper West Side, which was the single most productive box in the whole Apple history, doing $60, $75 million a year, always used to have 1,000 people. It's it's one of these huge glass stores. You could always see everybody on the floor. Used to have 1,000 customers any time of the day. It was open from 10 to midnight. I walk by that store all the time because I'm only 4 or 5 blocks away from it. It is barren. You could bowl over there. That, yes, I know it's just simply anecdotal. It's just simply one data point, but that data point projects, because I am in the most attractive demographic for Apple. I bought an Apple 15 because I had no choice. My phone died out. But who really needs an Apple product? We all have every Apple product we need at this point. So the replacement cycle, I think, is going to be minimal. And the growth in Apple will be India, but it's just not rich enough right now to really pick up the pace the way Apple needs. So to me, I think Apple, which is such a huge part of NASDAQ, could be a massive disappointment. That takes us down as we go forward. Anyways, my point is NASDAQ is right now one of the most dangerous trades. As 50% up, it could be 30% down next year. Let's take a look at the chart here. So yeah, I mean, and I just wanted to kind of show you, this is 23 revenue growth estimated, and I think 24 revenue growth estimated are going to be slower, not higher. Even Nvidia, which is projected to be so high, is just nowhere near that. And one of the ways you can see kind of mean reversion, one of my buddies put up this this chart here, which I think is really interesting. It's basically comparing NASDAQ against the hard goods like the gold miners and the oil stocks, and you see, there's just this massive levitation in terms of valuation. And I think also you can see sort of on NASDAQ in terms of all-time highs, it's kind of a double toppy formation. Here, reversion to the mean is a much more interesting call, I think, than it is to go higher and higher. It looks super bright. They always say it looks brightest in the morning, but sometimes it's just the oncoming train coming at you. So don't let it hit you in the face. So that's NASDAQ. That's a double top. I think pretty much in the making. I'll eat my words if it goes 20,000, but we'll see. Now the last ideas that we have is, and we've talked a little bit about this already, kind of the anti-dollar trade. If we think the dollar suffers because of sovereign debt concerns or some other, or the fact that we have interest rate compression, what are the two trades that I think are interesting? Obviously gold, we made a strong case for gold, but Bitcoin also becomes a very interesting trade on a whole bunch of interesting reasons, not the least of which that Bitcoin is actually going to another level of halving, right? So there's going to be more, it's going to require more and more computation to create a new Bitcoin. That means it becomes supply is diminished, and while demand is going to go up. That naturally creates an upward movement in Bitcoin. Furthermore, Bitcoin is really not a, I mean, gold is, as we saw, sorry, we can go to gold. You can just see that, you know, it's near all-time highs, great performance times of stress, but positioning in gold is relatively crowded. What's interesting in Bitcoin is that positioning in Bitcoin is not. After the very, very large, you know, decline in Bitcoin, the retail has been so burnt by Bitcoin that I think until you see Bitcoin at fresh all-time highs and everybody starts talking Bitcoin 100,000, you're not going to see the kind of retail participation you need. But what will really help retail participation at that point will be the Bitcoin ETF. There was even a BlackRock article today, and BlackRock is going to is making an appeal to create an ETF where the market makers and dealers are going to be able to create Bitcoin out of cash, not even out of Bitcoins, to make it even more liquid for retail traders. So the moment Bitcoin becomes digitized, in other words, you don't have to have a wallet, you have to buy it on chain, you have to do any of the crazy stuff that 90% of retail can't do. At the moment it becomes just an investable securitized asset, it could really have a huge amount of flow, because the way people are going to participate is buy the Bitcoin ETF, and then the underlying is going to go up because the dealers are going to do arbitrage. So both of those trades are good. Bitcoin, obviously, I think what you see on the Bitcoin side here, the large speculators are essentially not buyers yet, and that's, the commercials are buyers, are just small buyers of Bitcoin, and that's a positive thing. You always want to be on the side of commercials when you're looking at positioning.
So as you can see, 2024 is going to be a turbulent year ahead with elections, central bank actions, swirling political uncertainty. There are plenty of opportunity between, the Japanese yen, the Mexican peso, shorting euro yen, going long Bitcoin, as well as, looking at gold. But all of you are here today because you recognize that, fundamentals matter. That, even if you are used to looking at charts, chart reading has never been enough. You want to know what is driving the markets, what drives and determines and creates the long and short-term trends in the markets. And that's what we shared with you today, which is that it is the fundamentals that determine the what you should be trading, the direction that you should be trading, and technicals should be what you're using to determine when to enter and exit your trade. That's what Boris and I do every single day, which is we fuse fundamentals with technicals. It's not like we're just trading on fundamentals or just trading on technicals. So we're going to open up the floor to questions soon, but first, many of you have been begging me to create a fundamentals course to teach you more about fundamentals, and that's basically what I've done. I've finally, sat down, put together a fundamentals fast track trading course. And this fast track trading course is basically like a crash course in fundamentals. 13 video lessons instantly available. I'll teach you what really creates the short and long-term trend of currencies, how major news events impact your trades, how to turn market correlations into profits. We looked at a lot of charts. We looked at inflation chart. We looked at, the Fed Fund Futures dollar chart. We looked at bond charts. All of that is tradable. And it's important to understand it, because even if you're not trading it, it's important to understand what those markets are telling you. And also how to combine all of that information with technical analysis, along with Euro trading strategies and tips. In this course, I've also included as a bonus my personal cheat sheets for trading news, as well as, risk on, risk off, along with other things. And you get access to my personal trading view watch list. So you can just click on the link and download my watch list and be able to use it as a part of your trading. And I've made this, as affordable as possible. We're launching this course in 2024. It is a crash course, so it's, basically everything you need to know in a, condensed format. And, I'm just introducing it and rolling out, and as a gift for you that you're attending this webinar for 1 day only, you can get this entire course along with my cheat sheets, my trading view, and you'll learn how to trade fundamentals for, a little more than a nice dinner, nice holiday dinner out with your significant other or spouse. So definitely, consider this. If you are serious about learning how to trade fundamentals, there's no better way and no cheaper way to do it like this. I just want to get you guys in the right step and make sure that you know what to be looking at as the year begins, because it is going to be a very, very turbulent year. So this is something I wanted to share with you. Another thing I want to share with you is that I've got my friend Paul here, who has invited me, and Paul will speak in a moment, to a really fun event in Bali. It's for those, especially those of you that are in Asia. In March, Boris and I are going to conduct 4 full days of live trading in Bali between March 18 to March 21. It's going to be 4 full days from morning till night. We'll trade the New York Open, we'll trade the Asia Open, but it won't just be us. It's going to be 20 professional traders that will sit with you in a room and spend 4 days teaching you how to trade with you. It's a real communal experience. I'm really excited that he invited me. It sounds like a lot of fun. Sounds like some really nice, personal time, one-on-one time together. And we are doing the Bali trading event live in March. So Paul, I don't know if you want to come on, if you want to share a little information about the Bali event. You can attend the event either online or live. Now live, we've only got 3 spots because we've got so many people signed up already and we have a limited capacity. We only have 3 spots with us in Bali. But Paul will also be streaming the event live. And so for those of you that want to attend, the event online live, you can also do so as well. Do you want to share some information about it, Paul?
Yes, Kathy, that's thank you very much for that. Yeah, look, I think the thing that's really unique about this event is accessibility to traders. We all know how cool it is to watch Boris trade in his trading room, how good it is to watch you trade, Kathy, but in this event, you can come in and you can sit next to Boris while he trades. You can look at his screen while he's looking at his screen. You can sit next to Kathy while she's trading. You can come in, you can sit next to mystery trader Leon, who's just finished running a 200, as an analyst for a $200 billion fund. Gordon Scott, who is wrote the CMT qualification in the US, he'll be there. And you can literally, so there's 20 traders. There'll be about pretty professional traders, about 30 to 35 students. So the ratio is really good. And what we don't do is have people sitting in rows or 20 traders at the front and 30 clients at the back. We sit in a big semicircle around. We mix the seats up. So you really can come in and do a full trading session next to one of these amazing professional traders and see exactly what they're doing. And in addition to that, they stay in the same hotels as you do. There's only 4 hotels the traders stay in, so you can bump into them at breakfast and ask a question. You can have a coffee with them during the day. They're not there for anything else but to trade and to help clients trade. So the level of accessibility is just unachievable anywhere else. You get a real chance to experience what it's really like to sit with professional traders while they trade.
I've never done anything like this before. I've never had, 4 full days one-on-one with a group of traders or small group. So I think it's going to be a lot of fun. And we're going to have dinners together. We're going to have lunch together. And I think it would be a great experience. So once again, this is very limited. There's only 3 spots for the live Bali retreat. But online, you can join us if you'd like as well. Boris is going to share the links for both the fundamental course along with the Bali retreat for any of you that are interested. I know many of you are coming in from Asia. And hopefully, we have, we'll be able to help you become a better trader through fundamentals, through, learning, through trading. And that's what, really seek to do every single day. So now I'd like to open up the floor to any questions you may have. I know it's been a very long session and many of you have stayed, and I'm really excited about that. And those of you that are watching on demand, definitely hit those links. If you're interested in learning how to use fundamentals to trade or joining us in Bali. Okay, so I have some questions. Does Kathy trade the Nikkei? I do not trade the Nikkei. I trade Forex, I trade gold. Boris trades the US 30, he trades NQ, he trades Bitcoin as well, but we don't trade the Nikkei. But the Nikkei, you know, could be a good investment vehicle.
Yeah, the Nikkei is a great investment vehicle. It's not, the spreads are a little too wide to day trade Nikkei. Well, you could position trade it, and actually, you know, that's something we could definitely do. One of the things that we do is, you know, we also have a really, really great position trading group that I trade with. So if you come join us, I'll be happy to explore that with you as well. But the really cool thing, you know, that I want to talk to you about today was you cannot trade without fundamentals. Charts is not enough. That's a key thing you need to understand. Anybody who just trades by charts dies by charts. Every single professional trader in the world understands fundamentals, understands positioning, and positions their technicals in the favor of fundamentals. So it's like basically knowing how to know the alphabet, knowing how to write. You can't really have a conversation until you understand the basics of investing. And the basics of investing isn't double tops and double bottoms or fib retracements. Those are just derivatives of the underlying force, which is what's demand, what's supply, and that's driven by fundamentals. So that's why it's really, really important. That's why Kathy created this whole course. Literally thousands of people a day just bother her all day long in Discord asking her 1,000 questions. And that's why she decided, I'm going to put all of this together into the best possible module I can, make it literally free. I mean, you know, $89. She was saying that's a dinner. That's a plate of pasta in my diner in New York City these days. But it's nothing. You know, the value of this is lifetime. So anybody who doesn't have the course, or even if you kind of understand fundamentals but really want a great kind of a reteaching of it, that would be awesome. And of course, with Paul, for those of you who really want to, you know, ball her out and have a great time with us, we definitely want to see you in Bali. I mean, who doesn't want to be in Bali? I've never been. I'm dying to go. And it is a really, really different experience when you're sitting next to somebody and trading. I always learn much, much better. I don't know if you guys are the same way, but whenever I'm sitting next to somebody who's a real expert, I learn from them just by watching them and, you know, and talking to them 1,000 times faster than if I read the exact same thing that expert has written. You know, yes, I can read, I can write. It doesn't matter. There's just something incredibly powerful about the intimacy of being together with a person to absorb information and absorb techniques. And, you know, like even with cooking, you know, if you cook with somebody who's a really great cook, your cooking goes up by a factor of 20 after just one, you know, cooking event with somebody. It's the same thing with trading, and that's why this is such an interesting event. You can never truly teach this stuff unless you're there in person. So if you're down for it, as Kathy said, there's only 3 spots left. We'd love to see you guys there.
So one of the questions is a question I get asked a lot, which is where can I get central bank news about meetings, summary, what happened? You know, included in the course is one of the cheat sheets is my favorite fundamental resources. There's a lot out there. I talk about them often. You know, Forex Live is good, lots of them, but there's a lot of different ones. And, you know, I include my favorite list on the fundamental course. And I'm always adding, I'm going to be adding things to the fundamental course. It's 13 videos now, but if something's been interesting, you know, I'm going to add to it. We've got also a Discord community just for the members fundamental course. So if there's something interesting that's happening on a fundamental basis, you know, ask me there, I'll chime in as well. So there's a lot of really great, you know, resources there. What is the fundamental relationship between the Mexican peso and the Swiss franc? I mean, the peso is considered a risk-on currency. Swiss franc is considered a risk-off currency. Those are things that, you know, I teach. Those are things you'll learn, what that means, what's the significance of it. But basically, Mexican peso is sensitive to global growth, and the Swiss franc is more of a safe haven vehicle when that happens. Let's see, is there any questions on YouTube?
Yeah, there's some questions. I'm having a hard time posting.
Do I think dollar yen is going to? Do you think the dollar has been oversold against the Japanese yen? No. No, because, you know, we think that the yen is going to rally this coming year. We think it's going to be a good opportunity, and that is why I don't think that the yen, dollar yen, is oversold at all. I think we're at the beginning of some losses in dollar yen.
I just posted the link in YouTube.
Okay, great. All right, so you guys are asking for the links. Great.
Some people are asking, how do you who trades MEX Swiss? Few people do, because it's an obscure pair. But what Kathy was saying is you can do a synthetic cross. You basically do equal weighted trades. One where you are short, where you're long dollar Swiss, right? So it means you're short Swiss, and the other one where you are short dollar MEX, which means you're long MEX. Synthetically, it's the exact same thing. You just hold two positions instead of one. And because this is a carry trade, you're not going to be day trading this for a couple of pips. You're going to be holding this for hundreds of pips. It's an excellent position as a carry trade hold. So don't worry about the spreads. The spreads are minuscule when you're holding it for hundreds and hundreds of pips. That's the way to do it.
Okay, so if there are any further questions, you guys can always feel free to email us at Kathy@bktraders.com or Boris@bktraders.com. I hope you enjoyed this market outlook. There's a lot of information to watch for and a lot of ideas to consider for the coming year. It's certainly going to be an interesting and turbulent year in the markets. And many of you, as I said, are expressing your interest in fundamentals by attending today's session. So if you want to take my fast track trading course, it's a really good way to get a good primer on the markets and understand how markets, what really creates the short and long term trend of currency.
Somebody just bought the course already. So go ahead. I'm telling you, this is going to go up. You got 24 hours to lock it in for less than $100. Please do it. And don't come crying to me in 24 hours, because Kay is going to raise the prices. I have no control over it. So go out there, go buy it now. You'll be very thankful, I promise you. Have a good day, guys.
So our YouTube, if you're interested, is just YouTube/BK Forex. Alrighty, so thank you so much, Paul, for joining us. And for those of you that really want to have a fun trading vacation, then join us in Bali, and make sure you grab a spot now, because we only have 3 spots left in the conference. The course, you'll have access. The fundamental course is lifetime access, Raul. Once you have it, it's yours.
Yeah.
All righty. And it does not include zip. It is just a fundamental course teaching you how to use fundamentals to trade Forex. All right. Thank you so much. Thank you, Paul. Thank you, Boris. And we wish you